Imagine investing in the roads you drive on, maybe the schools your kids attend, or, the hospitals right there in your town, and then getting paid interest on that investment. Interest that the federal government can't even touch. Sounds almost too good to be true, doesn't it? Well, welcome to the world of U.S. municipal bonds. We got a whole stack of material here from one of our listeners, really digging into this, fascinating corner of the fixed income market. And today, our mission really is pretty simple. Take all the source material and just give you a really clear picture of what U.S. municipal bonds are. Why they seem to be getting attention right now. Unpack those unique tax benefits everyone talks about. And, importantly, expose some tax traps you really need to know about. We'll break down the different kinds you can actually buy, walk through the risks involved naturally, and hopefully help you think about how they might or might not fit into your own financial picture. Think of this as your shortcut to getting smart on munis fast.
That's a great way to put it. Municipal bonds, or munis as everyone calls them, they're really more than just pieces of paper representing debt. They're fundamentally the financial backbone for a lot of America's local infrastructure. And for you as an investor, they offer this kind of blend, potential income, relative safety, and some pretty powerful tax advantages that are frankly hard to find elsewhere.
But it's not just about tax-free, is it?
No, not at all. Understanding them means looking beyond that headline. It's about understanding who's issuing the bond, mechanics of how you get paid back, and all those sometimes subtle nuances that affect their value and their risk.
Exactly. So let's peel back that first layer. Let's get right down to the absolute basics. What exactly are U.S. municipal bonds at their core? The material says they are essentially debt obligations issued by public entities in the U.S.
Yes. Think states, cities, counties, towns. Could even be more specialized local government bodies like school districts, transportation authorities, utility districts. When these places need to borrow money, say, for a big project, they issue bonds. So if you buy one, you are, quite simply, lending them money. You become a creditor. You hold a formal promise from, say, your state or city to pay you back.
Okay. So I'm lending money to a government entity. Makes sense. But why do they need to borrow in the first place? What's the actual purpose behind issuing these bonds?
Well, the primary purpose, and the sources really highlight this, is to fund essential public projects. We're talking about the critical infrastructure and services that, communities rely on every single day. The examples given really paint a clear picture. These bonds finance the construction of schools where kids learn, hospitals where people get care, highways and bridges that connect us all, water and sewer plants that, keep us healthy, electric systems, airports, public universities even. Municipal bonds are really the financial engine that builds and maintains these vital community assets.
So, as the lender holding this contract, this IOU from the government, what specifically does the bond promise me? What do I get?
It promises two main things over its life. First, you get periodic interest payments, often called coupon payments. And second, you get the return of your initial principal amount, that's the money you originally lent, on a specific date down the road. That date's called the maturity date. So essentially, you're paid for letting them use your money, and then at the end, you get your original loan amount back, assuming everything goes to plan, of course.
Got it. Interest along the way, principal back at the end. Now let's break down some fundamental terms here that describe a municipal bond, because understanding these seems pretty key. First up, face value.
Right, face value, sometimes called par value. That's simply the amount printed on the bond certificate itself. It represents the principal amount that the issuer, the city, the state, whoever agrees to repay you, the bondholder, when the bond matures. And this face value is also the base number used for calculating those periodic interest payments we just talked about. So if a bond has, say, a $5,000 face value, that's the amount you expect to get back when it matures, assuming, the issuer doesn't default.
Okay. And tied directly to that face value is the nominal interest rate, or the coupon rate.
Exactly. This is the stated interest rate, and it's typically fixed right when the bond is first issued. It tells you precisely how much interest the bond will pay each year based on its face value. So take a simple example. A bond with a $1,000 face value and a 4% coupon rate. That bond will pay you $40 in interest per year. Now, most commonly, this interest is paid out twice a year, semi-annually. So in that case, you get a $20 payment every 6 months. It's worth noting, while most munis have a fixed rate like that, the sources do mention some can have floating rates that adjust over time, but fixed is more common.
Okay. Next term, the issuer. This is who you're actually lending your money to.
Correct. The issuer is the government entity that's responsible for making those interest payments and ultimately repaying the principal. For municipal bonds, we're talking states, cities, counties, or their specific agencies, like a water authority. And their financial health, their stability, their ability to generate revenue, all that is absolutely paramount when you're assessing the bond's risk. The material kind of contrasts this with corporate bonds, where the issuer is a company. A government with taxing power is generally seen as a different kind of credit risk than a private business.
Makes sense. Then there's the term, or maturity, how long the loan lasts, basically.
Exactly. This refers to the length of time until the bond matures and that principal amount is repaid. It could be very short term, just a few months, or it could be really long term, like 30 years, maybe even longer in some cases. And this is a really, really critical characteristic for you as an investor. Why? Because it determines how long you'll be receiving those interest payments. And, crucially, when you get your principal back, the sources specifically highlight something important here. A bond's maturity length has a significant impact on how volatile its market price is before it matures.
Oh, okay, hang on. Tell me more about that volatility link. Why does a longer maturity mean more price sensitivity? That seems counterintuitive almost.
Yeah, it trips people up sometimes, but it makes sense when you think about interest rates. It's all about how existing bond prices react when overall market interest rates change. So imagine you bought a bond paying, say, 3% interest. But now, new bonds being issued today are paying 5%. Well, nobody's going to want to buy your old 3% bond at its face value when they can just go out and get a brand new one paying 5%.
Right, of course.
So, for your 3% bond to be attractive to a buyer in the secondary market, its price has to fall. It has to drop below face value until its effective yield matches that new 5% market rate. Now, here's where maturity comes in. The longer the maturity on your 3% bond, the more future 3% payments you're stuck receiving before you get your principal back, compared to the higher 5% rate available now. That difference, stretched out over many, many years, means the price of your existing long-term bond has to drop more dramatically to become competitive with the new higher rate bonds. So longer terms essentially amplify the effect of interest rate changes on the bond's price if you try to sell it before maturity.
Oh, okay. That makes perfect sense. Now, the fixed payments just become less and less attractive over a longer period if newer bonds are paying more. Got it. Okay, finally, the issue price.
Right. This is simply the price at which the bond is initially sold by the issuer to the very first investors. Like the IPO price for a stock, but for a bond. It can be sold right at face value, that's called selling at par, or it could be sold below face value at a discount, or even above face value at a premium, and which one it is depends heavily on market conditions at the time the bond is issued. Things like, what are prevailing interest rates doing? What's the issuer's credit rating look like? Are there any special features on that particular bond? All that plays a role.
Okay, fantastic. That covers the basic building blocks. So you're lending money to a public entity, they use it for projects, you get interest payments, you get your principal back eventually, and these terms, face value, coupon, issuer, maturity, issue price, define the specifics. Now, let's get to the main event for many people, the headline feature, the thing that attracts so many investors, the tax advantages.
Yes.
Yeah.
The primary draw. And the sources are very clear on this. Generally speaking, the interest income you earn on tax-exempt municipal securities, well, it's exempt from federal income tax.
Yeah.
That is a massive benefit, especially when you stack it up against the interest you'd get from, say, corporate bonds or even many savings accounts, which is typically fully taxable at the federal level.
Federal tax-free income.
I know.
That alone sounds pretty compelling.
It really is. But wait, as they say, there's potentially more. The interest can also be exempt from state and local income tax. Now, this state and local exemption usually, keyword usually, applies if you are a resident of the state that actually issued the bond. So, for example, if you live in Florida and you buy Florida municipal bonds, the interest you receive is likely free from federal tax, Florida state tax, which they don't have anyway, but hypothetically, and any local income taxes. That makes it tri-tax-free.
Tri-tax-free. Nice.
Yeah. But if you live in, say, Texas, and you buy bonds issued by New York, well, the interest would likely still be federal tax-free, but you'd probably still owe Texas state income tax, if Texas had one, or any applicable local taxes on that New York bond interest. It depends on residency and the specific state laws.
Okay. So federal exemption is pretty common for these tax-exempt munis, but the state and local part depends on where you live and where the bond is from. But why does this tax stuff really matter so much, especially you mentioned for folks higher up the income scale?
Right. This is where we get into a concept that is absolutely crucial for understanding the true value here. It's called the tax equivalent yield, or TEY. This is often the aha moment for investors when they grasp this. See, the sources point out that because of this tax exemption, municipal bond coupon rates themselves are often lower than the rates you'd see on comparable taxable bonds like corporate bonds with a similar credit quality rating. So if you just glance at the stated coupon rate, the corporate bond might actually look more attractive on the surface.
But, right, that corporate bond interest gets taxed at your regular income rate.
Precisely. So to make a true apples-to-apples comparison, you need to figure out what a taxable bond would have to yield before taxes to give you the exact same amount of money in your pocket after taxes as the tax-free muni does. That resulting number is the tax equivalent yield. The formula the sources provide is pretty straightforward. Tax equivalent yield concludes tax-free yield. 1, your tax rate.
Okay, hold on. Let me process that. You take the yield the muni pays you, tax-free, and you divide it by 1 minus your marginal income tax rate. That could be just your federal rate, or maybe federal plus state and local if that applies.
Exactly right. You use the total marginal tax rate that would apply to taxable investment income.
Okay, and the number you get from that calculation, that tells you the equivalent yield a taxable investment like a corporate bond would need to offer before taxes to be just as good as the muni after taxes.
You've got it. And this is precisely why the benefit gets magnified for higher income investors. Think about the math. The higher your marginal tax rate, the smaller that denominator one tax rate becomes. Dividing by a smaller number results in a higher tax equivalent yield. The JP Morgan source actually gives a really compelling example of this. They say for top U.S. taxpayers, and they make some assumptions here, like a 37% federal rate plus the 3.8% Medicare surtax on investment income, an A-rated municipal bond in a high tax state like New York or California can offer a taxable equivalent yield of nearly 7.0%.
Wow, hold on. A 7% taxable equivalent yield.
From an A-rated muni, that's pretty significant.
It is, according to that source's data at the time. And they contrast that with the yields on cash, which were hovering just a little over 4% in their analysis. So this vividly demonstrates the power of that tax exemption. It can make a municipal bond with a seemingly lower coupon rate actually deliver a much higher after-tax return than many taxable alternatives. Especially note, in the current yield environment where both taxable and tax-free rates have generally moved higher, this is a big part of why munis are getting a closer look right now.
So it boils down to,
Yeah.
the higher your tax bracket, the more that tax-free coupon is effectively worth to you on an equivalent basis.
Absolutely. It disproportionately benefits those facing the highest marginal tax rates. Oh, and the sources also touch on another little tax poke. It's about original issue discount bonds, or OID bonds. If you buy these specific bonds when they're first issued at a price significantly below their face value and you hold them all the way until maturity, the gain you realize, that difference between what you paid and the face value you get back, is generally treated as tax-exempt interest income, not as a taxable capital gain. Another potential plus.
Okay, the tax advantages sound genuinely fantastic federal exemption, maybe state local too, and that really powerful TE calculation boosting the effective return. But the sources are also careful here. They include a section kind of like, whoa, hang on, or think twice, because it's not always perfectly tax-free, is it? There are potential pitfalls, tax traps.
Yes, and this is really important not to just gloss over. One common tax trap they mention is something called the alternative minimum tax, or AMT. For certain high-income individuals, some types of muni interest, even if it's classified as federally tax-exempt for regular tax purposes, may be considered a preference item in the separate AMT calculation. So depending on your overall tax situation, your income level, other deductions and credits you might have, a portion of that supposedly tax-free muni interest could actually end up being subject to the AMT.
Oof. Okay, that's definitely a subtlety to be aware of, especially for higher earners. What else could potentially trip an investor up on the tax front?
Well, remember, the tax exemption generally applies to the interest payments you receive while holding the bond. If you decide to sell that municipal bond before its maturity date, maybe in the secondary market, any capital gains you make on that sale, meaning you sell it for more than you originally paid for it, well, that profit will likely be subject to federal and potentially state capital gains taxes. So the interest was tax-free, yes, but the profit from selling the bond itself usually isn't.
Gotcha. Interest tax-free, capital gains potentially taxable. And there's another point here that seems really relevant, particularly for retirees. Something about Social Security income.
Yes, this is a crucial point from the sources, especially if you're relying on both muni bond income and Social Security benefits in retirement. Here's the catch. Your tax-exempt municipal bond interest is included when the IRS calculates your adjusted gross income, or AGI, for the specific purpose of figuring out how much of your Social Security benefit is taxable. So a higher AGI, boosted by that muni interest, can actually increase the portion of your Social Security benefits that becomes subject to federal income tax. It's an indirect effect. The muni income itself isn't taxed directly, but it can push more of your Social Security income into the taxable category.
Wow, that's a really valuable point to highlight for retirees.
Mhm.
Okay, what about buying bonds in the secondary market? Maybe ones that are trading at a discount to their face value. The sources mention a specific tax rule called the de minimis rule. This one sounds a bit technical.
It is a bit technical, but it's absolutely vital if you're considering buying discounted munis. Let's try to break it down simply. Okay, so you buy a municipal bond in the secondary market for less than its face value, or technically less than its revised issue price if it was an OID bond. But let's stick to face value for simplicity. That difference between what you paid and the face value is called a market discount. Now, the de minimis rule sets a threshold. If that market discount is very small specifically, less than 0.25%, a quarter of 1%, multiplied by the number of full years remaining until the bond matures, then that discount is treated favorably. It's considered a capital gain when you eventually redeem the bond, either at maturity or if it gets called early. And capital gains tax rates are often lower than ordinary income tax rates.
Okay, so if the discount is tiny, basically negligible under this rule, it gets taxed like a capital gain when I get my money back. That sounds good. But
Yeah.
what if the discount is larger than that de minimis threshold?
This is the less favorable outcome. And the key point, if the market discount is above that de minimis threshold, meaning it's more than just a tiny discount, the IRS generally requires you to treat that discount amount as ordinary income when the bond is redeemed. And as you know, ordinary income tax rates are typically higher, sometimes significantly higher, than long-term capital gains rates. This can make a big difference to your actual after-tax return from buying that discounted bond. You might have thought you were locking in a gain tax at lower capital gains rates, but instead, you end up paying higher ordinary income tax on that discount portion of your return.
Whoa.
Yeah, it's a really key factor to analyze when you're looking at munis trading below par in the secondary market. It fundamentally changes the math on your effective yield.
That rule definitely changes the whole after-tax return calculation for discounted bonds. It's not just about the price you pay versus the face value you get back. The tax treatment of that difference is critical.
Exactly right. And finally, on taxes, the sources really stress this. Tax laws are complex, they can change over time, and everyone's individual tax situation is unique. The benefits and pitfalls we've been discussing are general rules, but how they apply to you depends entirely on your total income, your deductions, where you live, everything. So the advice is clear. Always consult with a qualified tax advisor before making investment decisions based primarily on perceived tax advantages.
Excellent points on all those tax nuances. So the benefits are definitely powerful, especially for high earners, but you absolutely need to be aware of potential traps like the AMT, that indirect impact on Social Security taxability, and especially that de minimis rule if you're buying discounted bonds. Okay, now that we've covered the why, the tax angle, and the what, the basics, let's dig into the actual landscape of municipal bonds. What are the different types you might encounter out there? The sources highlight a pretty fundamental division here.
Yes, the main distinction you need to understand in the munibond world is between general obligation bonds, usually called GIO bonds, and revenue bonds. The core difference between them lies entirely in the source of money used for repayment. Where does the cash come from to pay you back?
Okay, let's start with the GOs then. General obligation bonds.
Right. General obligation bonds are typically considered to be backed by the full faith, credit, and taxing power of the issuer. That's the classic phrase you'll hear. What does that mean in practice? It means repayment comes from the general tax revenues of the state, city, county, or local authority that issued the bond. This includes broad-based taxes that governments collect, things like sales taxes, income taxes, property taxes. The issuer, the government entity, essentially pledges its fundamental ability to levy and collect taxes from its citizens to repay the bondholders.
So their ability to pay me back is tied directly to the overall economic health of that city or state and the government's effectiveness in actually collecting taxes.
Precisely. GIO issuers must have the legal authority, the power, to levy and collect taxes. These bonds are often seen by retail investors as perhaps simpler to understand because the repayment source seems tied to the overall financial health and tax base of the government entity, which might feel more familiar. The sources also note that issuing JGO bonds often requires voter approval first, and governments are usually subject to statutory limits on how much debt they can take on. These can be seen as adding a layer of fiscal discipline or oversight. However, it's also true, as the sources point out, that the tax revenues supporting JGO bonds can be more cyclical. They can be quite sensitive to economic downturns. For instance, a recession can significantly reduce sales tax collections, or a sharp drop in the stock market can hit state income tax revenue hard, particularly from capital gains taxes.
Okay, so JOs are backed by that general taxing power with its own cyclical sensitivities. What about the other main type, revenue bonds?
Revenue bonds are fundamentally different in how they're secured. They're secured only by the revenues generated by a specific project that the bond helped finance, or sometimes by certain specific taxes or fees that are dedicated solely to that purpose. The key here is that repayment comes solely from that particular income stream, not from the general taxing power of the broader government issuer.
So sticking with your earlier examples, if the bond funded a new airport terminal, the revenue bond payments would come just from things like airport user fees, landing fees, parking revenue, maybe rent from concessions.
Exactly right. Or, if it funded a toll bridge, the payments come only from the tolls collected. If it funded a water system upgrade, payments come from the water bills people pay. If it funded a nonprofit hospital wing, the payments come from hospital revenues. Or sometimes it might be a specific sales tax that's been earmarked by law just for, say, mass transit improvements. The issuers for revenue bonds are often entities that provide a specific public service, think utilities, transportation authorities, or they might be nonprofits like hospitals and universities. In some cases, private corporations can even be involved as so-called conduit borrowers for certain types of projects.
And what are the key characteristics or things to know about these revenue bonds?
Well, because repayment depends entirely and solely on that specific income stream from that specific project, the sources stress that detailed credit analysis of the underlying project itself and its management is absolutely essential. You're not just evaluating the city's overall budget, you're evaluating the viability and financial health of that specific asset, the airport, the water system, the hospital. How well is it run? Are the revenue projections realistic? Interestingly, the sources note that sometimes the disclosures and financial reporting for revenue bond issuers can actually be more frequent and transparent than for some smaller local SOGO issuers. You might get more specific data on the project's actual performance.
On a lot of these projects, they provide essential services, right? Stuff people can't really do without.
Yes, that's often a key feature and a potential strength. Many underlying projects for revenue bonds, think water, sewer, electric systems, provide absolutely essential services. Demand for these is relatively inelastic, meaning people need them and will likely continue to pay for them even in tough economic times. Furthermore, these types of issuers often have the legal authority and sometimes even a requirement under the bond agreement to raise their rates or fees if necessary to ensure they have enough money coming in to cover their debt obligations. That can add a layer of stability to the revenue stream.
That Bloomberg Municipal Index data cited in the sources, it shows revenue bonds actually make up the majority of the muni market, doesn't it?
It does, yeah. According to that data, revenue bonds constitute about 2/3, roughly 64% of the index by market value, compared to about 34% for GOs. This really underscores just how prevalent and important revenue bonds are in the overall municipal landscape. They're not some niche category, they're the dominant type.
And this prevalence, combined with the extra analysis needed, leads to something the sources call the complexity premium. What's that about?
That's right, because analyzing a revenue bond properly requires you to really dig into the specifics, the operations of that particular project, its unique revenue streams, the quality of its management, the local market conditions. And because that's generally more complex than just looking at a city's overall tax base and budget, many individual retail investors find them less accessible. Or maybe they're just less comfortable doing that kind of detailed project-specific analysis. This lower demand from a significant segment of the market means that, generally speaking, revenue bonds tend to offer slightly higher yields than JGO bonds of similar credit quality and maturity. So for investors who are willing and able to do that extra credit homework, this complexity premium can represent an opportunity to potentially earn a higher yield for the effort.
And that inside source
Also highlights just how diverse the revenue bond sector is. It's not just one thing.
Absolutely. It breaks it down really well. Transportation is a big piece, about 20%. Then you've got water and sewer at 16%. Hospitals are at 12%. Education, like universities, is 12%. Special tax bonds are another 12%. Leasing arrangements make up 11%. Electric utilities are 8%. And housing is 7%. And then there are smaller percentages in other areas like industrial development revenue bonds, IDRs, pollution control revenue bonds, PCRs, and resource recovery projects. This diversity is really significant. It means you can invest in very different types of essential projects and revenue streams. It allows for a lot of customization and diversification within your muni bond allocation, letting you focus on sectors you understand better or perhaps feel are more stable.
Okay, so the main divide is GOs, backed by general taxes versus revenue bonds, backed by specific project income streams. That's clear now. But the sources mentioned several other notable types too. We should probably touch on those.
Definitely. One important category to be aware of is taxable municipal bonds. Yes, while the big headline is always tax-free, the reality is that not all bonds issued by municipalities have federally tax-exempt interest. Taxable munis are issued when the activity being financed doesn't meet the federal government's criteria for providing a broad enough public benefit. Common examples might include bonds issued to finance professional sports stadiums, certain types of housing projects that are primarily investor-led rather than for broad public purpose, or even bonds issued specifically to address severely underfunded public pension obligations.
So wait, if my city decides to build a fancy new baseball stadium using bonds, the interest I receive from those bonds might actually be federally taxable.
That's often correct, yes. The sources mention the Build America Bonds BABs program, which was introduced after the 2008 financial crisis, as a major past example of taxable munis. Those BABs paid taxable interest to investors like you, but the municipality itself received a direct federal subsidy to help offset their interest costs. That program expired, but taxable munis are still issued. Because they lack the tax exemption, taxable munis generally have to offer higher gross yields to attract investors. They can be particularly attractive to investors who don't benefit from U.S. tax exemptions anyway, think certain non-U.S. investors or maybe tax-advantaged accounts like IRAs or 401k, where the additional tax exemption of a muni doesn't really provide an extra benefit.
Interesting. Okay, what about zero coupon bonds?
Zero coupon munis are structured differently. They're issued at a significant discount to their face value. You might pay, say, $700 for a bond that matures at $1,000. The key difference is they don't make any periodic interest payments along the way. No coupons. Instead, your entire return, the principal plus all the accumulated interest, is paid out as one lump sum when the bond matures. Now, an important tax point the sources note, even though you don't receive any cash interest payments each year, the interest that is accruing internally on the bond may still be reportable for tax purposes annually. This is called phantom income, and it can be a consideration if you hold them in a regular taxable account. Also, because all the return is packed into that final payment way out in the future, their market prices tend to be more volatile, more sensitive to interest rate changes than regular coupon-paying bonds.
Right, that makes sense. And market discount bonds. We touched on the tax implications earlier with the de minimis rule, but just recap, what are they again?
These are simply municipal bonds that you buy in the secondary market, meaning after they've already been issued for a price that is less than their face value, or technically less than their revised issue price for OID bonds. This discount might exist because market interest rates have risen since the bond was first issued, making its lower coupon less attractive. Or maybe the issuer's credit quality has deteriorated a bit, increasing its perceived risk. And as we discussed, how that market discount is taxed when you eventually get paid back, whether as lower tax capital gains or higher taxed ordinary income, depends crucially on that de minimis rule threshold.
Got it. What about insured bonds?
These are municipal bonds that come with an extra layer of protection, an insurance policy from a commercial bond insurance company. The insurer essentially guarantees that they will step in and make the required interest and principal payments if the original municipal issuer defaults and fails to pay. The sources offer a key piece of advice here. When evaluating an insured bond, you really need to assess the creditworthiness of both the underlying municipal issuer and the insurance company providing the guarantee. The strength of that insurance guarantee is only as good as the financial health and stability of the insurer itself.
Right, the insurance is only valuable if the insurer can actually pay up if needed. Okay, conduit bonds. This sounds a bit like the municipal agencies just acting as a middleman.
That's a pretty good way to think about it, actually. In a conduit bond structure, a municipal agency, like a state financing authority or an industrial development agency, acts as the official conduit issuer. But they're issuing the bonds on behalf of a third-party borrower. This borrower is often a nonprofit organization, like a private hospital or a university, or sometimes even a private company for specific qualifying projects, like pollution control facilities. Here's the critical point. The third-party borrower is the one solely responsible for making the debt payments from its own revenues. The municipal conduit issuer itself is generally not obligated to repay the bondholders if that third party defaults, unless the bond documents explicitly state otherwise, which is rare. So for you as an investor, the credit analysis needs to focus almost entirely on the financial strength and viability of that underlying third-party borrower, hospital, the university, etc., not on the municipal agency whose name is on the bond as the issuer.
That's a really important distinction. Okay, housing bonds.
These are typically revenue bonds secured by mortgages on single-family or multifamily housing units, or by the repayments made on those mortgage loans. A unique feature the sources mention for housing bonds is that they can often be called or redeemed early, not just when interest rates fall, like regular call risk, but also if the underlying homeowners prepay their mortgages faster than expected. They might also include specific extraordinary redemption provisions that allow for an early call under certain unpredictable circumstances, like if the housing project suffers significant damage from a natural disaster or loses a key government subsidy. This adds an extra layer of uncertainty about how long you'll actually hold the bond.
Okay. And finally, municipal notes. These sound short-term.
They are. Municipal notes are short-term debt obligations issued by municipalities. They typically mature in 1 year or less, although sometimes they might go out to 2 or 3 years. Governments usually issue these notes to manage temporary cash flow mismatches, essentially, borrowing money to cover immediate expenses while they're waiting for anticipated tax revenues or other funds to come in. You'll often see them referred to by acronyms based on the expected repayment source. TANs, tax anticipation notes, RANs, revenue anticipation notes, or BANs, bond anticipation notes, issued ahead of a planned long-term bond sale. They're primarily tools for short-term liquidity management by the issuer.
Wow. Okay, that is a much more complex and diverse picture than just thinking tax-free government bonds. We've got GOs backed by taxes, revenue bonds tied to specific projects, and all the different kinds of projects within that. Taxable munis, zeros, discounts, insured, conduits, housing, notes. Understanding these types definitely helps frame the potential risks involved. Because while municipal bonds are often talked about as being relatively safe, the sources are very clear. Like any investment, they absolutely come with downsides and risks you need to carefully weigh.
Absolutely. It's crucial. No investment is entirely risk-free, and munis are no exception. One of the key risks, which is common to essentially all fixed income investments, is interest rate risk.
Okay, we touched on this with maturity, but how does it specifically apply to munis in general?
Right. As we discussed, if prevailing market interest rates rise after you've purchased a bond that pays a fixed coupon rate, the market value of your existing bond is likely to fall. Why? Because new bonds being issued now will offer those higher interest payments, making your older, lower coupon bond less attractive to potential buyers unless its price comes down to compensate. Conversely, if market interest rates fall, the price of your existing bond will likely rise, making it more valuable. And as the sources reiterate, bonds with longer maturities are significantly more sensitive to these interest rate changes. A relatively small increase in market rates can cause a much larger percentage price drop in a long-term bond compared to a short-term one. What this means for you is, if you think you might need to sell your bond before it matures and interest rates have risen since you bought it, you might get back less than your initial principal investment when you sell.
That's a critical point for anyone thinking about holding bonds primarily for income, but still potentially needing access to their principal down the line. Okay, next risk, call risk.
Call risk is the risk that the issuer will decide to redeem, or call back, the bond before its scheduled maturity date. Many, though not all, municipal bonds are issued with call provisions that give the issuer this right, usually after a certain number of years have passed, known as the call protection period. Why would they do this? Issuers typically exercise this call option when market interest rates have fallen significantly since the bond was issued. It's financially advantageous for them. They can essentially pay off their older, higher interest debt early by issuing new bonds at the lower current market rates. It's very similar to why a homeowner might refinance their mortgage when rates drop.
Okay, but for me as the investor, getting my bond called early
That isn't necessarily a good thing, is it?
Often, no, it isn't ideal. While you do get your principal investment back sooner than expected, the main disadvantage is that you are then forced to reinvest that money in a financial environment where interest rates are now lower. It can disrupt the steady income stream you were counting on, and it makes it challenging to find a new investment that offers a comparable yield to the bond that was just called away from you. This is often called reinvestment risk, and it's triggered by the call risk. And as the sources note, some types of bonds, like those housing bonds we mentioned, might even be continuously callable from day one or subject to those unpredictable, extraordinary redemption triggers, which adds even more uncertainty about the bond's expected holding period and your future income stream.
Right. Okay, then there's liquidity risk.
Yes, liquidity risk is an important characteristic of the municipal bond market that investors need to understand. Compared to very large, highly active markets like the one for U.S. Treasury bonds or for major, widely held stocks, the market for individual municipal bonds can be significantly less liquid. The sources explain this is partly due to the sheer number of issuers, literally thousands of different states, cities, counties, school districts, etc., issuing bonds across the country. And it's also due to the enormous variety of bonds outstanding, different issuers, different structures, different features, different maturity dates.
So does that mean finding a specific bond I want to buy or trying to sell a specific bond I already own might actually be difficult sometimes?
It can be, yes, especially if you own a bond from a smaller, less frequent issuer or one with unusual features. If you hold a specific municipal bond and you suddenly need to sell it quickly before its maturity date, it can sometimes be challenging to find an interested buyer right away. Or, even if you find a buyer, you might have to accept a lower price than you'd ideally hoped for, precisely because of that lack of deep active trading for that particular bond. Often, investors looking to buy individual munis focus on finding bonds that meet certain general criteria, say an A-rated California Go bond maturing in 10 years, rather than searching for one particular bond identified by its unique CUSIP number. This relative illiquidity compared to treasuries or stocks is definitely something to be aware of, especially if you anticipate needing quick and easy access to your invested capital.
That's good to know. Okay, credit and default risk. We heard the historical data sounds very positive overall, but default is still a possibility, isn't it?
It absolutely is. Credit risk, or default risk, is simply the risk that the municipal issuer will be unable to make its required interest or principal payments on time, or perhaps at all. Now, the sources do cite that impressive historical data from Moody's showing very low default rates over the long term. That cumulative 10-year average default rate was only 0.15% for all municipal bonds tracked between 1970 and 2022. And it was even lower, just 0.09% for bonds that were rated investment grade. They also mentioned there was only one single municipal bond default recorded in 2022 among the issues they track. These numbers are historically significantly lower than the default rates typically seen in the corporate bond market.
Okay, those are definitely reassuring numbers in comparison, but a 0.15% average over decades still means defaults do happen, even if rarely. What kind of factors increase that risk?
Well, it really depends heavily on the type of bond we're talking about. For revenue bonds, the credit risk is tied directly to the financial health and the operational performance of that specific project generating the revenue. So if that project runs into unexpected major costs, or if usage declines significantly, like fewer people using a toll road than projected, or if there's mismanagement, any of those things could jeopardize its ability to generate enough cash to make the bond payments. For no-go bonds, on the other hand, the credit risk relates more to the overall fiscal health of the issuing government entity itself. Things like the strength and diversity of its tax base, its ability to manage its budget effectively, the health of the local economy, and increasingly, the burden of unfunded obligations like public employee pensions, which can put a significant strain on government finances and potentially impact their ability or willingness to prioritize debt payments.
And that revenue sources risk mentioned is essentially just drilling down deeper into that specific analysis for revenue bonds.
Exactly. It's taking a closer look at the specific vulnerabilities of the particular income stream that backs a revenue bond. Well, as we said, essential service projects like water and sewer utilities are often quite resilient because demand is inelastic and they can usually raise rates. Other types of projects might be much more susceptible to economic swings or change in consumer behavior. The sources use that vivid example of how the COVID-19 pandemic caused a sudden stop in revenue for many airport bonds as travel just completely halted almost overnight. So, not evaluating a revenue bond, assessing factors like the underlying regional economy, the exact nature of the revenue source, is it user fees, A dedicated tax, lease payments, the project's operational track record, any legal protections built in for bondholders, like covenants requiring rate increases if coverage falls low, or debt service reserve funds, and the overall quality of the project's management, all that becomes absolutely crucial.
Okay. Political risk seems like it would be more prominent for the EGO bonds tied to the government itself.
It generally is, yes, primarily for Jew bonds. This risk involves not just the government's ability to manage its finances prudently, but also, importantly, its willingness to do so. Are they willing to make tough decisions, like raising taxes or cutting spending if needed, to ensure fiscal stability and meet their debt obligations? Political considerations can heavily influence budget forecasts, tax policies, spending priorities, and even the timely passage of budgets and necessary legislation. The sources also make a sobering point. In the rare instances where U.S. municipalities have actually gone through bankruptcy involving Dugo debt, the historical recovery rate for those bondholders has often been quite low, averaging only around 40 to 60 cents on the dollar of principal owed. Now, essential service revenue bonds are often considered somewhat better insulated from this direct political risk, partly because they tend to have more professional, operationally focused management structures separate from the general government budget process. However, even there, recent events, like some court rulings related to the Puerto Rico debt crisis, serve as a stark reminder that rigorous credit analysis, including understanding the legal and political framework, is necessary for all types of municipal bonds.
Right. Okay. Inflation risk is another one that applies broadly to bonds. How does it specifically look for munis?
Just like any other bond that pays a fixed rate of interest and promises to return a fixed amount of principal at maturity, municipal bonds are vulnerable to inflation risk. If the rate of inflation in the economy turns out to be higher than the yield your bond is paying you, then the purchasing power of those fixed interest payments and the purchasing power of the principal you eventually get back will diminish over time. The Investopedia source provides a pretty stark example of this from recent years. A municipal bond yielding, say, 2.5%, which might translate to a 3.3% tax equivalent yield if you're in a 25% tax bracket, simply cannot keep pace with inflation rates like the 7% seen in 2021, or 6.5% in 2022, or even the 3.4% in 2023. Your money is losing real value, even if the bond itself is perfectly safe from default.
So even if the issuer is rock solid and you get every single penny of interest and principal promised, the actual real-world value, what that money can buy, might be significantly less than when you first invested it, especially if inflation has been running high during the life of the bond.
Exactly. While holding low-yielding but safe munis can certainly preserve your nominal principal and provide that potentially tax-free income stream, they can definitely expose you to significant purchasing power risk, particularly during periods of higher inflation. This is one reason why financial advisors often recommend a diversified portfolio that includes assets with the potential to grow faster than inflation, like equities, alongside fixed income holdings like munis. It's about balancing different types of risk.
Makes sense. Are there any other, maybe less common but still possible risks the sources mention?
Yes, a couple more. One is repudiation risk. Now, this is extremely rare in the U.S. context, but there is a theoretical risk that a state or municipality could, under truly extraordinary and dire circumstances, attempt to partially or totally repudiate, essentially, disavow or refuse to pay its debt obligations if it deemed it absolutely necessary for other critical public purposes. There's no absolute ironclad guarantee against this, though again, it's a highly unusual and historically very rare event in the United States.
Okay, vanishingly rare but theoretically possible. And finally, special event risk.
Right. This is kind of a catch-all category for those unforeseen events that might not be captured by typical credit analysis or disclosed in the bond offering documents, but could still significantly impact an issuer's ability or willingness to pay its debts. Examples the sources give could include major lawsuits filed against a municipality or the specific project, significant unexpected legal or regulatory changes that dramatically affect the issuer or its key revenue source, maybe severe and unusual weather events or natural disasters causing widespread damage and economic disruption, or even other large community projects undertaken nearby that might unexpectedly siphon off revenue from the project backing your bond, like a new highway diverting traffic from an older toll road. It's essentially the risk of the unexpected, the black swan type event that falls outside normal projections and analysis.
Wow. Okay, that is a truly comprehensive list of risks to consider. So, summing it up, while the tax benefits and those historically low default rates are definitely strong positives for munis, investors really need to go in with eyes wide open about the sensitivity to interest rate changes,
especially for longer bonds. The risk of getting called early, the potential illiquidity of individual bonds, the specific credit risks that differ between GOs and revenue bonds, all those tax complexities beyond just the initial exemption, AMT, gains tax, de minimis, the real threat of inflation eroding returns over time, and even the possibility of rare political or special events causing trouble.
Understanding all those trade-offs, the full picture, is absolutely key to making informed investment decisions. No investment is just one-dimensional, good or bad. It's always about balancing risk and potential reward in the context of your own situation.
So, okay, if someone has listened to all of the basics, the tax angle, the different types, the whole spectrum of risks, and they're thinking, all right, I get it. I think munis might have a place for me. How would I actually go about investing in them? What are the main ways?
The sources outline a couple of primary ways to gain exposure to municipal bonds. The first, and perhaps most direct way, is buying individual municipal bonds yourself.
And how would someone typically do that? Where do you go?
You can usually buy individual munis through brokerage accounts. That could be one of the major online brokerage platforms, or by working with a traditional full-service broker or financial advisor. Some banks may also facilitate municipal bond purchases for their clients. The main advantage of buying individual bonds is that it allows you to select very specific issuers, maturities, credit qualities, and features that precisely align with your individual goals, risk tolerance, and maybe your geographic preferences, like buying bonds only from your home state for that potential tax-free benefit.
But, as we just discussed, that individual bond market can have those liquidity challenges. Finding specific bonds can be tough. And it really requires you to do or have someone do for you that specific credit analysis we talked about, especially for the revenue bonds.
Exactly right. Those are the potential downsides of the individual bond approach, which leads directly to the second and often more common approach for many investors, investing indirectly through funds.
You mean like municipal bond ETFs or mutual funds?
Precisely. Investing through exchange-traded funds, ETFs, or traditional mutual funds that specialize in municipal bonds is a very popular and accessible way for most people to get exposure to this asset class. These funds work by pooling money from thousands of investors and then using that collective capital to buy and manage a diversified portfolio containing hundreds or sometimes even thousands of different municipal bonds.
And the big benefits there are pretty clear, right? Instant diversification and professional management.
Those are the key advantages, yes. By investing in a fund, you get broad diversification across many different issuers, various types of bonds, GOs, revenues, different states or regions, and a range of maturities, all within one single investment. This diversification significantly mitigates some of those individual bond risks we discussed, like the risk of a single issuer defaulting, or the liquidity risk associated with trying to sell one specific bond. Plus, you have a professional fund manager and their team doing all the ongoing credit analysis, monitoring the portfolio, making buy and sell decisions, and managing the interest rate risk for you. And there's a wide variety of muni funds available too. You can find funds that focus on national munis, funds that specialize only in bonds from a specific high-tax state, if you're really targeting that tax-free income, or even funds that focus on higher yielding and higher risk high-yield municipal bonds for investors seeking potentially greater returns but willing to accept more credit risk.
This has been a really, really deep dive. We've gone all the way from the basic definition of a muni bond through that complex but crucial tax landscape, explored the different ways municipalities actually issue debt, and walked through that full spectrum of potential risks and the ways you can actually invest.
It really is a fascinating corner of the financial world, isn't it? It directly connects investor capital, maybe your capital, to the development and maintenance of local communities while offering these unique potential benefits, especially on the tax front, that are hard to replicate elsewhere.
So let's try to bring it all together now. Let's distill the key takeaways from all the material we've covered. First, municipal bonds are fundamentally debt instruments. Loans issued by states and local governments primarily to fund public projects. Their standout headline feature is the potential for the interest income they pay to be exempt from federal income tax, and sometimes also exempt from state and local taxes if you happen to live in the state that issued the bond.
And that tax exemption is really where the power often lies, particularly for investors in higher tax brackets. Because as we saw, it can translate into a much higher tax equivalent yield, TEY, compared to what you'd need to earn on a taxable investment to get the same after-tax return. That JP Morgan example showing potentially high TEYs for top taxpayers really hammered that home.
We also learned about the two main categories: general obligation, TU bonds, which are backed by the issuer's general taxing power, and revenue bonds, which are backed only by the specific income generated by the project the bond financed.
Understanding this distinction is absolutely crucial because their risk profiles and the type of analysis needed are quite different.
And while municipal bonds historically have had a very strong track record of low default rates compared to corporate bonds, especially for the investment grade ones, they are definitely not risk-free. We can't stress that enough. You absolutely must consider interest rate risk, especially the amplified risk in longer maturity bonds, call risk, the issuer paying you back early when rates are low, forcing you to reinvest at lower yields, the potential liquidity challenges if you need to sell individual bonds quickly. The specific credit risks tied to the issuer and the bond type, GEGO versus revenue, and all those potential tax complexities beyond the simple tax-free headline, things like the AMT, tax on capital gains if you sell early, and that tricky de minimis rule for market discount bonds.
And let's not forget the potential drag from inflation, eroding the purchasing power of those fixed payments over time, plus those less common but still possible political or special event risks. Ultimately, though, the sources seem to suggest that even with all these risks factored in, the current yield environment in the muni market, when you combine it with those powerful tax advantages, might present a potentially compelling opportunity right now relative to just holding cash or investing in comparable taxable bonds, especially for certain investors.
Indeed. Evaluating municipal bonds, like any investment, really comes down to looking at their potential benefits within the specific context of your own financial situation, particularly your individual tax bracket, your overall investment goals, your time horizon, and your tolerance for the various risks involved.
So building on that, here's a final provocative thought we want to leave you with. Something to chew on based on everything we've discussed from the source material. Considering the potential power of that tax equivalent yield, the relatively low historical default rates, and the current yield levels we talked about, how might incorporating municipal bonds, or perhaps adjusting your existing allocation to them, fit into your personal strategy, particularly if your goals include wealth preservation and improving tax efficiency? And maybe more specifically, how comfortable are you with the different risk profiles of general obligation versus revenue bonds? Which type seems more aligned with your own approach to analyzing investments and the level of complexity you're willing to take on?
It really is a balancing act, isn't it? Weighing those potential rewards, especially the after-tax returns, against that whole spectrum of risks we laid out, and understanding how those risks can manifest quite differently depending on the specific type of bond you're looking at.
And because tax laws are so complex, and everyone's situation is unique, processing all this information we've shared today and then taking the next step, seeking tailored advice from a qualified financial advisor or a tax professional who understands your specific circumstances, that's always the recommended path forward before making any actual investment decisions.
Absolutely. This deep dive hopefully provides a solid knowledge base to have that conversation, but personalized guidance is really invaluable when it comes to applying it to your own portfolio.
Well, that wraps up this deep dive into the world of U.S. municipal bonds. We really hope this exploration of the source material has equipped you with a much clearer understanding of this important and often misunderstood asset class.